Let's kickstart our first conversation of the day. And it relates to the recent underperformance of equity as an asset class. And you've seen a risk off sentiment globally. And this is affecting equity markets here in India as well. The question is that how does this affect your long term goals? Because it's a stated fact that equity markets do not move in a linear fashion, but you might need to recalculate certain things with regard to your expectations for the next couple of years at least. Joining me now to give you that perspective is Santosh Navlani, who is the Chief Operating Officer of ET Money. Thank you so much, Santosh, for taking the time. And the first point really, and we were talking about this to a certain extent yesterday, which is why asset allocation is so important. Equity markets have underperformed in the recent past, but if you had a good strategy on the asset allocation side, you would not be as impacted as somebody who had all of their money in one basket, which is equities.
Yeah, Alex. Hi. Yeah, as we discussed yesterday as well, putting money all the time in equities can give you disappointing experiences for a stretched period of time at occasionally, and maybe at times periodically in your entire investment journey as well. What has happened is over last 10 years or so, we have not witnessed a very strong correction which could have lasted for years together. All these things used to be quite frequent from late 90s till 2010 or so. But the frequency of these corrections have reduced a lot, or rather the time period taken to recover the lost value and back to regain the previous high has not taken so much time in last 10 years. And hence possibly people think, or investors think, that equity is a one-way street, and over the long period of time you always end up making money, hence stay invested. But when these kind of jolts come in, suddenly you lose the 20% of your value to the from the portfolio highs. You always feel a bit disappointed. But it always helps to look at things in context, that you will lose all that money entirely in proportion to the markets only when you are all putting money in equities in isolation and not diversifying across different asset classes. If markets today have corrected about 18% or so from the highs that we saw earlier part of 2021, then it's very easy to say that one has lost 18%. But if you are asset allocating well, booking periodic profits, then your return differential between Nifty and Sensex compared to your portfolio may not be as high as 18%. It would hardly be like you would have lost about 8 or 9 percentage points. So idea is, if you asset allocate well, there is always the a feeling that markets are getting ahead of themselves, the valuation getting stretched, the earnings growth may not materialize, the optimism that market is sharing may not be reflecting in real economy. When you read all these things, you should always be a bit cautious and really questioning yourself that should you take some profits off by asset rebalancing in the portfolio. And if you do that, then you don't only lock your gains that you've made, but also prevent your portfolios to go down with the markets. And hence, it's extremely important that you focus on asset allocation and never get into the flow that put all your money in equities, be it SIPs, be it lump sum.
Okay, I want to delve a little deeper into the last couple of decades, because I think even this time frame will teach us a lot. And on a bit of a lighter note, Santosh, I saw a tweet by a 23-year-old just the other day, and he was pointing out that he's seen several bear markets. And I found myself thinking that, at least his parents must have started investing on his behalf at the turn of the century, or at the turn of the millennium, certainly. But what have you learned from the dot-com crash in the early 2000s to the financial crisis to the taper tantrum to COVID? What have these events taught you?
Yeah, so I think all the learnings that we keep sharing on this channel in the show, Alex, they have all come from learning from the good and bad experiences, both during all these events that you talked about. I think I cannot claim that I was working and I had invested my money in 2000 because I was still a student. But I think history teaches you a lot more than what experiences, future experience can help you project things. So if you look at dot-com bubble, and I think many of our students' life was all about not being able to get the preferred placements or opportunities and the early part of the century, in that sense, if I were to say. What in 2000, when the Nasdaq and the S&P 500 touched their highs in around March to July 2000 period, many don't realize that it took 7 years from 2000 for S&P 500 to regain its previous high of what it achieved in 2000. It was about 1400 odd points, and it took 7 years for S&P 500 to go back to 1400 odd points. And for Nasdaq, it was about 4000 odd levels in 2000, in May of 2000, and it took about 16 years, around July 2016 or so, to regain the previous high. So what it teaches you is, sometimes the markets can actually have so much accesses that it takes not just few years, but probably a full economic cycle, and sometimes two economic cycles, to regain back to previous highs. And if you are somebody who's caught in this, in the cycle from start to finish, then practically you will have period of no returns on your portfolio. And that's where you should have your lesson number one, that don't put all your money in equities all the time. You should always look at multiple factors: valuations, economy, interest rates, your own outlook towards your professional life as well as future, and then decide how you should be investing your money. We don't realize the crisis that we saw in 2000 was far more deeper than global financial crisis, because global financial crisis, it took about 3 years odd to regain the previous value, compared to 4 years for Sensex, if I were to compare right now, coming to Indian markets. So Sensex saw its highest value about 6,000 points towards some point in 2000 year, and it took about 4 years or more to come back to the previous high. Same thing which happened in January 2008 in the global financial crisis. Sensex was nearing about 20,000 levels, and after the fall over 8 month period, it took 3 years in November 2010 to regain the lost value. But what we don't realize is actually from 2010 till most part of 2013, there were practically no returns, because market was just going up and down, up and down. So people who actually invested in 2008 and didn't start SIP, just put a lump sum, they possibly would not have earned even savings account interest or bank FD kind of returns from their equity investments. So what it teaches you is, there can be long periods of no return, long periods of drawdowns where you see a fall which you never recover from. Hence, having your money in different asset classes is extremely crucial, especially when you're planning your long-term goals.
Just one small point before we move into how one should strategize with regard to their financial goals is that you mentioned at the start of the program that we've seen these cycles in the equity markets in particular that have shrunk over the last decade or so. And you've seen smaller cycles in the recent past. Do you think that it's because of the velocity of funds that is now in the capital markets? You have the capital markets, of course, that have grown in size phenomenally. And with that in mind, do you anticipate that the cycles will continue to be this short?
I wish I knew the future, Alex. But to answer your question, it's like uh, I think in the entire from 2000 till 2010, the Indian equity markets were not as developed as they are today. The penetration of demat accounts, mutual fund as a category was not really as mainstream as it is today. So the number of investors that probably were there in this entire decade of the century, early part of the century, was actually far lesser compared to number of investors today. Also the behavior, I think the risk appetite was so low in that time period that the falls were not bought into easily. So it became almost no buyer market and only sellers market in those times. So and markets were also dependent a lot on FII money compared to domestic institutions or mutual funds for that matter. And look at today's times. We have extremely strong SIP flows, almost to the tune of 12,000 crore per month. Another set of money coming through, insurance companies, which when they invest their policy holders' money into equity markets via ULIPs and things like that. NPS, National Pension Scheme, putting money into the equity markets. EPFO, the Employee Provident Fund, money keeps coming in every month into the marketplace, almost like SIP. I think if I were to look at, India has almost close to 16,000 crore per month of money coming in only via these four sources of money: mutual fund, SIPs, NPS, insurance companies, EPFO put together. And that's a very large money to absorb. And hence, possibly the amount of corrections that you were seeing, the depth of correction you were seeing are not coming anymore these days. We don't know what the future will hold, but possibly investors are far more mature today. They buy the dip, they average out, they do more of SIPs than lump sum. I think all these things have actually played a role in short sucking the cycles of the economy. And of course, this entire decade has been all about easy liquidity globally. So even that has added to the kind of buoyancy or shorter cycles. We will see how we'll discover rather what happens in the future. But I guess we may not see prolonged correction periods as much as they were happening in the past. Maybe from 4 years they'll be down to 2 years. But I don't think we will possibly seeing a very shorter cycle like COVID, where market actually corrected by 40 odd percentage points from February to March 2020, and by November 2020 we actually were back to the previous levels. I don't think it is going to be that short as well.
Okay, fair enough. But coming to the most important point for people who are planning their long-term goals, it has been repeatedly stated that equity is the best instrument to use to achieve your long-term goals, because on an average, you can say with absolute certainty that over a 5-year plus period, you have an inflation beating investment option. But what happens when their goal culminates in a year or 2 years, and you've seen the kind of market performance in the recent past? Will that affect those goals, and how should these individuals plan their investments going forward?
Yeah, so Alex, I fundamentally believe that equity as an asset class remains the best way to grow wealth, best way to achieve your long-term goals, beat inflation. So nothing goes out from that aspect. The only thing that we need to remember is putting all money into equities at all points of time is not the right strategy. So what you need to do for your long-term goals, it's pretty simple. It's like nobody can forecast that we would have another global pandemic in which year. We would not know what happens to some kind of country where a developed economy goes under a deep recession, and how it affects global flows, how it affects the market outlook and things like that. Nobody knows that. So you can't really act on protecting your earned profits on your portfolio towards your long-term goals at the last moment. So let me try to simplify this by saying that, let's assume that you were planning for your child's education in the academic year of 21-22, and you needed some money towards April, May 2020, and you actually continue to stay invested in the markets till March. Now, chances are very high that most of your profits would have evaporated, and maybe you would have lost some principal value as well if you've been investing for 5 years, 10 years, or whatever. So 40% correction in the values would have wiped out most of your profits. Now, somebody in that zone for such a critical goal of one's child's education would have acted in panic and removed money in March 2020 and realized that market actually were back to levels in November 2020. And that kind of person would have gone to deep stress, not just for losing money, but also losing compounding itself on a long-term goal. Now, the way to avoid these kind of situation is not wait till last moment to remove money or start protecting your profits. I call it glide path way of investing, which we use a lot in ED Money Genius, which is our advisory offering, where we actually help people build portfolios with inbuilt glide paths into them. So what does glide path do? A glide path actually has a gradual movement towards safer assets from equities as you are nearing your goal. So for let's take an example. You are actually investing for a 7-year goal for something like owning a dream home, or actually planning your child's education of say bachelor's, or for the matter even retirement corpus of your own. And what will happen is, while the first 2 years in the 7-year period can be fully into equities, can be probably 80-90% in equities, but by the time fifth year comes, we all know that there is a 10% probability that you will still make a negative return or may not make a positive return by investing in equities for 5 years. What will happen is the system will actually go towards, or your own system as an investor, not just an ED Money Genius for that matter, should actually work in a way that you should possibly cut down equity exposure from 80-90% to say 60%, or whatever that number is, and go when you the third year, when you approach only just 3 years are remaining towards the goal, no, gradually again move a lot of your equity money into debt money. What will happen in this? You will not just move your equity monies, but also move your profits into protection zone by putting that money into debt kind of instrument or a gold kind of instrument. So what will happen is, as you grow, come near the goal from 7th year to 3rd year or 2nd year, you would actually follow this principle of taking money out from equities irrespective of market levels to the debt or safer assets kind of zone, and ensure that even if another pandemic strikes, global recession strikes, or any kind of liquidity crunch comes to the marketplace, your earned profits are protected by staying in debt or safer assets. And hence, when your terminal value is coming in, your goal is coming in, nothing can probably shatter your dream. And because 80% of your money would probably sitting in debt, only 20% be exposed to equities. And that's how you should be planning your long-term goals, and almost like a withdrawal phase of your investments in life.
Yeah, and you can use avenues or tools like STP if that is convenient, or you can move it lump sum, right? But Santosh, thank you so much for joining in, and I'm sure that that perspective is going to help a lot of people that have tuned in.
Sure. Thanks, Alex.